Hello, everybody. It's Friday. Everybody say woo woo Friday. If you could hear me, give me a big woo woo Friday. Where are my woo woo? It's Friday. Who's excited? Okay, so last night Adrian did a webinar on property ownership. Today I'm doing financing. Yuck, financing. I know Adrian went over some good concepts yesterday. Who could tell me some concepts he went over? I was on the webinar last night, so I know he said some good stuff. Anybody? Did some property ownership. He talked about the bundle of rights. He talked about the TIP, which stands for time, title, interest, and possession. Bundle of rights is your rights, your interest in the property, and the rights that go along that's transferred with the property when you buy it. He did say repute, which stands for rights. Actually, I'm not even sure what that stands for. That's a new one for us. I'll have to look that up. I'm not in love with that acronym, I'll be honest. I don't know if we'll continue that one. He did talk about eminent domain. What is eminent domain, Lex? So Lex Serrano says Adrian talks about eminent domain. What did he talk about? What is eminent domain? Eminent domain is the government's right to take your property for public use. Then just compensation would be paid. Okay. As opposed to police power, where they do not take your property. They just tell you to use it through things like building codes and zoning and everything of that nature. Talked about joint tenancy, which is the unity of time, title, interest, and possession, and also the right of survivorship. So good. So it's a little quick review of things we went over yesterday. Today we're talking about financing. When you talk about financing, what should come to mind? As per your real estate exam, obviously. What are some things that come to mind when we talk about financing? What do you guys think? What are things that come to mind when we talk about financing? So Stacy says loans, FHA. Okay, FHA comes to mind. What is FHA? What does that mean? What is FHA? So Cindy gave me the first tangible thing that comes up on your exam. So what is FHA? Who knows? Who could tell me? So what do they do? Not the Fair Housing Act. This is the Fair Housing Administration. I can see how that gets confused though. So basically, this is an institution that insures lenders from loss. So when people say they're getting an FHA loan, they're not actually getting a loan from the FHA. They're getting a loan that has a lender who's approved to be insured by the FHA. Has everybody got that? So you hear FHA loan all the time. And the reason they say that is because the person who's doing that loan is insured by the FHA. And what is the point of that? What is the point of the government insuring these loans? What do you guys think? What do you guys think is the point of that? So the whole point of them insuring the loan is to make buying real estate more accessible to people who are not super rich. Okay, that's the primary point. They didn't want to just insure lenders just for the sake of insuring lenders. They did it to make buying real estate more accessible for your average person. Before they did this, you had to be super rich to get a loan, which is kind of ironic because if you're super rich, you don't necessarily need a loan. And you see this a lot in less developed countries. Less developed countries, they say, how does the rich stay so rich in their position of power? It's almost like a familial system, is because they pass down real estate and they constantly buy real estate, and the poor people can't buy real estate because they can't get loans or anything like that, or the lending system's corrupt and whatnot. where we have the FHA. And because before the FHA came around, loans were like 7 years, and you had to be able to put some crazy amount of money down to get a loan, like at least 20%, all right, to get a loan, sometimes a lot more. So obviously only rich people could afford those big payments, those massive down payments. So the FHA came in and told the lenders, if you lend money to good people who have good credit and good history, etc., we will insure you from loss. We will insure you from loss. Okay, has everybody got that? So it was an attempt to make a more even playing field so the rich would not get richer and the poor could still own real estate as well. Okay, so when they got that FHA loan, loans went from like 7 years to more like 30 years, which is more commonly what you hear today. And it made it easier. People put 3% down. So the payments could be extended over a longer period of time, which makes it more accessible for your average person. Has everybody got that? Right, got it. And that's the primary reason for the FHA. Sorry if that lecture was a little longer. I just felt like if you understand the concept of it, then vocabulary or question scenarios will be less daunting, because as long as you understand the principle while it was all there, everything else kind of makes a lot more sense, rather than if you just memorize words and really have no idea what they're all about. So now when you say FHA insures lenders, you understand why. And what this also helps you understand, if you understand the principle why the FHA was formed, it'll help you understand the secondary market. Has everybody got that? So how does this relate to the secondary market? So how does understanding how the FHA was formed connect to the secondary market? What do you guys think? Who's got that one? So a lot of you guys are writing resale marketplace. That's just regurgitating what we have in the textbook and our notes, but who actually understands more of the concept? So the concept basically is, oh, and Deborah got it, free money up. That's what I was going for. Nice job, Deborah Gardner. Okay? It frees money up. And what that means is we just said the FHA makes loan money and they don't get paid back for like 30 years. Well, that could be a problem because the next person who wants to borrow money, they'll be like, oh, we'll lend you money, but can you wait 30 years? So remember, before that, they got their money much quicker in the form of larger down payments, and people paid back the loans in 7 years. Okay? But when the FHA came in, it made it much harder to do loans to lots of people because people weren't making these big down payments and they weren't getting paid back for a long period of time. So the secondary market came in to solve this issue. The secondary market came in to buy those loans as they could wait and collect money over the long term. And what that did, it gave these lenders more capital to do more loans. So the lenders became more in the business of doing loans, while the secondary market became more in the business of collecting that interest. Is everybody got that? Hopefully that context helps everybody understand that a little more. Because there's no point in learning about Ginnie Mae, Fannie Mae, and all that if you don't understand that key principle we just went over. If you are memorizing what Ginnie Mae is and you don't understand what the secondary market is, then really you're just memorizing Greek, assuming you guys don't speak Greek. Anybody speak Greek? I don't think anybody here speaks Greek. Okay, so that is that secondary market. Now, if that's the secondary market, what is the primary market? What is the primary market? I love Greek food as well. It's so good. Baklava. Is baklava Greek? I think it is, but it's good, whoever makes it. Okay, so what is the primary market? So the primary market, very simply said, is when you go into the bank and you get a loan. That's what that is, okay? It's when you go into the bank, you get a loan. When you can, and this is not always the case, really try and put this in real life terms. Very often it's very simple, okay? Now don't drive yourself nuts trying to put everything in real life scenarios because some of this stuff is really awkward. For example, the capitalization income approach is kind of hard to put in real life terms if you don't do commercial real estate. If you do commercial real estate, it's a little easier, but if not, it can be a little tricky. And it's better in that situation just to remember capitalization income approach turns income into value and leave it there. Trying to figure out how they go about finding it and whatnot could just make your head spin because it's very complicated. Okay, so the primary market is when the loans are made. All right, everybody with me so far? Right, I'm with you. This finance stuff could be really annoying, so I want to make sure everybody's with me. Okay, so you got the primary market, you got the secondary market. By the way, who falls victim to this? Where you guys start memorizing words, but you really don't know what the words really mean. You're just memorizing things out of the textbook. And you just read it and you memorize it, and then that's basically it. It's like saying, what is a fixture? Maria. I'm like, well, what's Maria about? I don't know. I just know to say Maria when you say fixture. Okay, I'm not sure why. I just say that. Okay, maybe that's not the best example, but you guys get the point. And the problem with sometimes doing that is if it's not phrased exactly as you memorized it for your exam, then you could be in trouble. But if you understand the context and understand why something is there, okay, then if it's not phrased exactly as you saw it, you're okay because you understand the context of everything. And you understand the principle of what is being asked. Okay, so we talked about the primary market and the secondary market. Another thing that comes up is this word conventional and unconventional. Conventional loans and unconventional loans. Who knows the difference? Conventional loans and unconventional loans. What do you guys think? Who knows this? Conventional loan and unconventional loan. Okay, conventional loans are not backed by the government. Unconventionals are backed by the government. Everybody got that? That's the key point you have to know. Okay, conventional loans are backed by the government. Unconventional loans are not backed by the government. We actually did a new video on that. Arthur, is that link available to share, or Adrian? I don't know if you guys are there for conventional, unconventional. Are we still working on that video? I believe we finished that video. If we did, if you guys could post that link, that'd be great. If not, you guys will have to be waiting for some excitement. Okay, the other big thing that comes up when we talk about financing is this idea of the OREE rule. So first, what is the OREE rule? Okay, and then we're going to talk about why it gets confused when we do financing. All right, so Adrian just posted an article for conventional and unconventional loans. Apologize, guys, the video is not up yet, but it's coming. It's going to be amazing. Okay, OR gives, EE receives. Oh, Arthur's got the video. Okay, so OR gives, EE receives. We learned the little song, lessor, grantor, optionor, giveor, propertor for your pleasure, EE, lessee, vendee, trustee, optionee gives me property, makes me happy. We understand OR gives, EE receives. OR gives, EE receives. Lacey, that video was for conventional, unconventional loans. And by the way, that video Arthur posted is the new style of videos we've been working on. So I really hope you guys like it and definitely give us your feedback on it because we're really trying to improve everything as always. We're trying to step up and we're kind of learning as we go. So as I said, we all started this just basically to help a few people. And as this has grown and the usership has grown, we're kind of learning as we do things. Okay, so we have the OREE rule, but it causes a lot of confusion when we talk about financing. Why does it cause so much confusion, the OREE rule? Anybody know? So it tends to cause a lot of confusion because the person who receives the money, okay, is actually the OR. Whether it's the trustor or the mortgagor, it's the OR. And that throws a lot of people off. They say, well, if they're receiving money, why are they the OR? So I'd like you guys to answer that question for me. Solve the confusion. This, as you guys know, is a pet peeve of mine because a lot of real estate instructors will say this is an exception to the rule. It's not an exception to the rule. It's a suffix. There's no exceptions to how you use a suffix. Adrian is a brilliant writer, and he will tell you you can't have exceptions to grammar. Grammar is grammar. Well, maybe there are some exceptions, but you get the idea. Not in this case. I have a feeling Adrian's going to write me later and be like, well, actually, Joe, there are exceptions in the English language with certain grammar rules. He's going to correct me. Okay, so Bridget said it very nicely because they are giving the promissory note to get the money. Okay, nice job, Bridget. So the reason they're the OR is because they have to give, right, the promissory note, which forms as the evidence of the debt. And that happens before you get the money. People think about the money, but nobody's giving anybody any money before they get some promise that they'll get paid back. All right? If they don't, that's not a loan. That's just a gift. Okay? If it's a loan, if I'm lending you money, well, by nature of it being a loan, I need some proof that you're going to pay me back first. So that OREE rule applies to the first action. Everybody got that? That OREE rule applies to the first action. And the first action is that you give the promissory note, which forms as evidence of the debt, before any money is given, which is why the mortgagor or the trustor is the OR, even though they're the borrower receiving the money and living in the property. Has everybody got that? Right, got it. Okay, and hopefully you guys are writing some of this down if need be. Okay, now when we talk about this exchange, there's another important principle that comes up for getting a loan, and that is the principle of equitable title versus legal title. Okay, Cindy is already way ahead of me. Cindy, you're reading my mind. Get out of my head, Cindy. Okay, so you have legal title and equitable title. So first, what is legal title? What is legal title? What is legal title? What do you guys think? Legal title represents the right to sell. It's true ownership. Okay, it's true ownership. What is equitable title? What is equitable title? Okay, so technically speaking, if you Google equitable title, what you're going to see is equitable title is the right to gain legal title at a later date, right? So if you guys Google equitable title, that's probably what you're going to come up with, okay? And that makes sense because equitable title means it's your property with the right to gain legal title, meaning nobody else could come in and pay off the lender and take over your property, okay? You have that right. The property is in your name via equitable title, so only you have the right to pay off the lender and get the property. So that's why when you Google it, it'll say equitable title represents the right to gain legal title at a later time. Does that make sense? All right, because if you didn't have that, then somebody else could go pay for it, and they could, own your property, and that'd be ridiculous. So what does that really mean? And that's when we talk about this right to use and possess and gain equity, which a lot of you guys are writing. So in everyday terms, so take away that technical definition, In everyday terms, it means the right to use and possess, meaning the right to open the door, kick up your feet, and watch whatever you want to watch on TV, eat what you want to eat, and do whatever you want to do in your house. Okay, that's what it literally means. The other way to remember it is equitable title sounds like the word equity. Equity is, well, what is equity? Who knows what equity is? What is equity? Who could tell me what equity is? So equity is your interest in the property above and beyond all liens against it. Okay, equity, I want you guys to remember that. In fact, if you guys could write that down, I'd really appreciate that. So I want us all to see that. It's a really important definition. Your interest in the property above and beyond all liens against it. And I'll say it again. It's your interest in the property above and beyond all liens against it. As we learn, liens is when you owe money. We talk about mechanics liens, income tax liens, property tax, judgment liens, all sorts of different liens. When you get a loan on the house, like in a mortgage or things of that nature. So liens when you owe money. So equity is that amount above and beyond what is owed. And I like to say it's what you could go buy a cookie with. I think some of you guys mentioned that in the chat. It's because I like to simplify and say it's the money you could take out and go buy whatever you want, like a cookie. Okay? So when we go back to this word equitable title and legal title, you said that the lender has legal title. But if at the time of the loan and the transaction, the house was worth 500 grand, and then it goes up to 600 grand, who gets that extra 100 grand, which is now equity? Does the lender get it? They have legal title. What do you guys think? Does the person with legal title enjoy that amount of appreciation above and beyond all the debt? Does the lender get that? No. The person with equitable title. Equitable title. You see how I tried to tie those words together? And hopefully that helps you guys remember as you guys are studying, okay, what equitable title really means. So equitable title, they get the equity. Does that make sense? And like I said, I'm thinking a lot of you guys memorize these terms and memorize all these words. So I really hope by me explaining this manner, it kind of connects it all and puts it in more context, which in turn will give you guys a better foundation as new concepts kind of come into the picture. So I really believe you need a good foundation with this stuff before you start learning new things and other things and things of that nature. Okay. Keep it simple, right, everybody? Let's take a break from the lecture and let's do a question that's on the board. A builder wants to offer financial assistance to prospective buyers, but does not want to lower the price of the homes. Instead, the builder agrees to pay a lump sum in cash to a lender at closing so the buyers will enjoy a low interest rate. What type of loan is this? A buy down, B, open end, C, participation, or D, equity? What do you guys think? The answer is buy down. Good. Okay, let the buyer beware is also known as what? E2, eta, ad valorem, caveat emptor, or lease pendants. Let the buyer beware is also known as what? E2, eta, ad valorem, caveat emptor, or lease pendants. And the answer is caveat emptor. Who can tell me what the other words mean? Let's start with E2, eta. What do you guys think that means? Nobody knows? Okay. What is ad valorem? Ad valorem. We all know ad valorem, right? Ad valorem. What is that? Ad valorem means according to value. Okay, it's according to value. And lease pendants is what? Lease pendants, Latin for lawsuit pending. Which statement best describes a VA loan? A loan insured by the Department of Housing and Urban Development, which offers low-income people the chance to become a homeowner. B, a loan funded through the U.S. Department of Veterans Affairs for qualified veterans on approved properties. C, a loan backed by the U.S. Department of Veterans Affairs, which offers veterans and service personnel the opportunity to buy a home with favorable terms, often with no down payment required. Or D, a variable adjusted mortgage that adjusts monthly to reflect the prevailing legal interest rate. Congratulations, Mary. Mary passed in California. Good job, Mary. What part of California, Mary? Let us know. Okay, and the answer is C, a loan backed by U.S. Department of Affairs, which often veterans and service personnel the opportunity to buy a home with favorable terms, often with no down payment required. Mary's in Glendale. Arthur and I know all about Glendale. That's actually where Arthur and I met. Actually, no, we didn't. Maybe we met in Los Angeles first time? Who knows? I think it was Glendale. Okay, moving right along. Who provides funds for the Department of Veterans Affairs? A, HUD, B, approved lenders, C, Freddie Mac, or D, the secondary mortgage market? And the answer is approved lenders. Approved lenders. Good. So next week, you'll be seeing a lot more of Adrian than me, which is always good. Adrian will do a great job. I will be getting surgery on my nose. Got to get a little thing removed. Yeah, I shouldn't even brought up E2, ETA. You guys are focusing way too much on stuff that doesn't matter. And you guys do that, you end up like focusing on things that you shouldn't be focusing, like over analyzing and stuff. Okay, the difference between the value of a property and the total amount of liens against it is known as A, equity, B, a down payment, C, actual cash value, and D, collateral. Lex, let's not get saucy. What is that expression? Don't get saucy with me, Bernays. What is that, History of the World? It's one of the Monty Python movies. Okay, the answer is equity. We went over that before. How many of you guys know that reference? Don't get saucy with me, Bernays. I think that's like early 80s stuff. What movie is that from? Is that Monty Python and the Holy Grail, or is it History of the World? Is it sassy? No, but sure it's not saucy. Anyway, now we have to Google that later. Generally, as the employment rate and the GMP both rise, A, the level of personal income rises. B, sales of existing home loans will remain level or increase. C, all the answer choices are correct. Or D, new residential developments will increase in numbers. Thanks, Erica. Surgery is always scary, but I'm hoping this isn't that big. Us people with a very light complexion, we're in the sun a lot, could sometimes develop little scary dots that need to be removed so it doesn't turn into anything much worse. Okay, C, all the other answer choices are correct. Okay. Oh, don't get saucy, Bernays, from Mel Brooks' History of the World Part 1. Thank you, Adrian. Saucy. Haha! When the deed in which you take title to a property contains the following clause, subject to the existing loan. A, you agree to assume the loan and make the payments directly to the lender. B, the lenders guarantee that you alone will pay off the loan. C, you are in danger of losing the property if the seller does not make the payments on the underlying loan. Or D, the seller is permanently relieved of the liability. And the answer is C. You are in danger of losing the property if the seller does not make the payments to the underlying loan. Rachel said real estate law is hard to study when you're sick. Frankly, I think it's better to study when you're sick because you fall asleep a lot easier. You open this book and you'll be out in like 2 seconds. This stuff is snooze alert central. When a property is appraised as part of the loan application process, a copy of the appraisal, A, is confidential and for the lender's use only. B, must be shared with all parties. C, is given to the seller only upon written request. D, must be provided to the borrower. And the answer is D, must be provided to the borrower. How many of you guys can't sleep at night? You say, well, I can't sleep. I'm really awake, so I guess I'll get some studying done. And you're like, all right, I can't sleep. I'm going to get some studying down, open my book, and then you're out in like 2 seconds. The moment you open your book at night, you're like, oof, I just got really tired. I don't know why. Must have been that big exercise I did this morning. But you like have good intentions at night, but then the moment that book opens, you're like, I'm done. Okay, this will be the last question of the day. To determine the amount of economic obsolescence suffered by a commercial property, the answer to which of the following questions would be most relevant? Can the building be operated efficiently? B, should a fire escape be installed? C, are the tenants in the neighborhood prospering? D, is the rental schedule of the building equitably charged to the tenants. And the answer is C. Are the tenants in the neighborhood prospering? All right, guys, that's it for today. I hope you guys have a great weekend. Adrian will be back on Monday morning, so he'll be there at 9 o'clock West Coast time, 12 o'clock East Coast time. You guys do the math of where you are in between. Other than that, this is Joe from PrepAgent with Adrian and Arthur. Have a great weekend, guys. Thank you so much for attending.